Well, hello and welcome everyone to this Friday educational webinar with RightCapital Financial Planning Software. My name is Daniel Gregoire. I manage RightCapital's training and onboarding teams, and I'm excited to be joined by Kelly Flush for this presentation as well.
Hi, everyone. Thanks for joining us today.
And we are thrilled to be able to bring you this content on customizing return scenarios within financial plans. And ultimately, this being a webinar for RightCapital, of course, we're specifically talking about the financial plans you generate in our system. And we are excited because this conversation today is one that can really help to unlock some of the keys to the castle, if you will, within RightCapital, and really making sure that the system is aligning return assumptions and return projections over the client's life expectancy in a way that really aligns with your unique advising philosophy. So we are here to walk through this step by step. We're going to start kind of at the beginning of it by looking at the assumptions and then evolving the conversation into how to project different rates of return for different accounts or different times of a client's life. And then we're even going to talk about customizing, let's say, return sequence to say, what if there's, let's say, a recession in 5 years, or what if we want to compare two plans and look at the impact of one that has, let's say, some more guaranteed income streams or more conservative investments, and how those might interact with different applications of outcomes in terms of the market conditions. So again, we're excited today to walk through all of this, and ultimately what we want to do is, number one, just encourage all of you to ask any questions that you have as we make our way through the presentation. We know there's probably going to be a lot of them, but we are going to answer all of them. So don't ever fret. We are here to make sure that you have the information you need to be successful. So on that note, if you're newer to RightCapital, within these webinars, you can always reach out to us via the control panel under Go to Webinar. So that is something where you can just type in directly to us. We will either type back to you if it's a quick question, or maybe it's something you need to troubleshoot with us. Kelly can get back to you. But then at the end, we're actually going to take time and walk through every question we get to make sure that everyone gets those, answered and feels comfortable with the information. We'll also make sure you know where to find additional resources if, in fact, there are more questions along the way. So just by the nature of the conversation and the number of people in attendance, we won't be turning anyone's microphone on besides our own, just to keep audio clutter down. But of course, we're here to help. So type questions into us and know that we're here to help. For those of you, again, who are newer to RightCapital, it's also good to remember that these webinars are all hosted within within our help center at RightCapital. And we'll show you where to watch the replays on demand whenever you'd like at no cost. It's always available to you. So with all that being said, everyone, I think it's time to actually dive into our agenda and make sure you all have a good idea of what we're going to cover today. So first and foremost, let's dive into what we're planning on discussing within this particular webinar. Now, the first thing I want to actually do is just make sure everyone's comfortable with aligning their unique advising thoughts in terms of the actual returns that we'd see within a financial plan to every client individually or to a global assumptions area. That's just a key part of understanding the building blocks of the financial plan, and that's where the conversation begins today. We're then going to look at the different settings that all of you can leverage to customize the different outcomes of the markets and also what investment strategies clients are actually using within the actual financial plan. And so that's going to be kind of the second component. And then we're going to talk through, of course, the Monte Carlo scenario, but how we may actually create our own unique Monte Carlo trial. Let's just think about creating one of the many trials that we run to stress test a plan, whether it's a recession coming down the road in 5 years, or whether it's a bad decade followed by slow growth. We're going to look at all of that analytically and talk about how those are applied to the financial plan. And then we're going to review, of course, the key outputs and where you can really compare and contrast these different outcomes, and where you might see value in adding them in. Might there be a time when we're looking to show the benefit of an annuity or some guaranteed income streams, or a more, let's say, conservative investment strategy with some different what if scenarios? So this is all going to be part of the process today, and we do expect this to run a little longer than usual. Typically, these webinars run for about 30 to 35 minutes of content plus Q&A. We expect this one to last for around 40 minutes plus Q&A. So we'll be here as long as we need to, but we ultimately want to make sure the content is where it needs to be, and then we'll transition to questions at the end. So we're excited. We hope you are too. We hope everyone had a wonderful holiday break and a great New Year's, and hopefully everyone's staying healthy and safe. And one of the first things I'm going to do today is actually just launch a quick poll, just to get an idea of how long have all of you been using RightCapital software. So just going to run this real quick. It's just going to help us determine how we move through the data today. So you will see a prompt here. How long have you been using RightCapital software? Again, just a quick reference is just going to help us get an idea of who's on the call today and understanding how we can move through the content. So appreciate everyone's participation. Looks like most of us have been around for quite a while, but some of us are a little newer. So we'll take the time to go through all the good information for everyone here and answer any questions that are needed. So wonderful. Thank you so much, everyone. Now, what I'm going to do, which is, of course, the fun part of the presentation now, is transition over to RightCapital software, and we're going to start working through all this data together. So I'm going to, of course, use just a typical case study for us, but before we dive into that particular case study today, I'm going to actually review some of the background information that sets the stage for the conversations that we're going to have. And those background data points are going to be found here within your advisor portal landing area of RightCapital. So this is, of course, my login, and we can see that at the very top of the screen, one of the important areas that we always recommend you take a look at before you get too deep into doing many financial plans are the actual global assumptions that we use to actually guide rates of return and inflation within every financial plan that you create. And I just want to remind everyone that the data here as a default is going to be pulling asset return information from around 50 years of historical index averages for US equities and 20 years of historical average data from indexes for US bonds. And essentially, every investment within RightCapital is categorized through Morningstar in order to be aligned with an asset class, which is then projected into the future in the Monte Carlo scenario using a breakdown of interest, dividends, and capital gains, which make up our total returns. And as well, we have volatility adjustments as well for each asset class. Now, everyone can adjust the returns. So whether you're a basic subscriber or a platinum subscriber, if you want to make sure that you're aligning, let's say, these asset returns with the JP Morgan report and some forward-looking assumptions rather than historical averages, you can do that, and we'll actually provide you a reference data link at the bottom of the screen here so that you can actually see not only the historical indexes that we pulled our averages from, but also some forward-looking alternatives if you'd like as well. But all of the actual projections for the client's investments within the Monte Carlo scenario and all the different types of market scenarios we can enter are all going to kind of tie back to the rates of return and the volatility assumptions for the investments. And this is the starting place where you as the advisor make sure that at a global level that we're reflecting information that you believe to either be true or to be comfortable with as we look 30, 40, 50 years into the future. So that is the starting place today, everyone. And I want to just remind you that if you are a platinum subscriber, you will have the ability to adjust volatility by asset class and even build in customized asset classes, using these additional tabs of asset classes and correlation. But, for the majority of us, we're just going to have this asset return tab inflation tab and the miscellaneous tab, which talks through some just other minor assumptions within every plan. So that's the starting place, right? We know that every financial plan that has investments entered into it is going to be using and leaning on the actual return assumptions to be able to, look at how those investments will grow, and how they would be impacted by, let's say, market losses with the volatility percentage. So now we're actually going to look at the financial plan together and take a look at the actual returns that we see within the financial plan, and go for some additional looks on how we can adjust the data, adjust settings, and others. Quickly do want to address a quick question. Are the historical base projections regularly updated by RightCapital? That's a really good question that we always get, and I want to just reiterate that we at RightCapital update our assumptions for rates of return every single year. And so actually within the next few weeks, you're going to likely get an email from us that says we are going to update our return assumptions. Here are what they are, in terms of the new updated averages, but we'll never change them after you've signed up with us. We just will provide you with the new data set to change them if you wish, because the logic is if we went in and changed them for you, that would actually change the outcomes of all your financial plans. And we don't want to do that. So we'll just email you early Q1, again, the next few weeks. You'll get the new updated averages in our email, and you can then reference those, adjust them as needed, or leave your assumptions as is. So it's up to you, but we'll provide you with all that data on an annual basis in Q1. Great. So the next thing I do want to just quickly mention to everyone is that this is at a global level. So these asset return assumptions are here. They are available, as in the advisor portal to say every new client plan that I enter is going to align with those asset return assumptions. But we all know individual clients maybe have some strong opinions on these types of projections and assumptions as well. So for that reason, we actually give every single client plan the option to kind of customize those assumptions as well. So if I visit our case study for today, Tommy Callahan, and open the client up, we will be able to see that I can actually visit customized return assumptions for Tommy and Beverly here. So I just want to remind everyone that every financial plan, when we open it, is going to have the option for me to visit the gear icon, sub-tab settings, where we will in fact have the ability to update those return assumptions as well. So again, maybe this particular client, has some strong beliefs about different, rates of return for the future or inflation assumptions. I can customize all of these different assumptions per client, including things like inflation assumptions and even other tax law assumptions. So just be aware of that overall. Now, when it comes down to looking at this particular client and how we're projecting, of course, their investments into the future, we always want to start with, what is RightCapital doing as, let's say, like a baseline? How are we, just right out of the box when we first get into RightCapital, how is the system treating investments over time? How are we treating rate of return over time? And how does that impact the financial plans before we start getting into all the customization? So the first thing I'm going to just identify is that in the data entry of RightCapital, we rely on the net worth area under the investments to tell us how every investment account is going to be growing into the future. And the logic here is that essentially we're going to be able to build out investment accounts in two separate ways. The first way is pretty simple, which says that we just are going to enter a total balance for this 401k account. For example, again, this would be step 4 of the initial data entry if you were building a financial plan for the first time, and you'd be potentially adding an investment account or maybe linking one from an outside source. And with the total balance approach, you can actually just enter the total value of this 401k account and choose the asset allocation that will guide the returns on this account for the future. So for example, I can choose a model portfolio that says this particular 401k account is going to be aligned with a moderate asset allocation or a moderate model portfolio that's going to, provide a 60-40 breakdown of the equity and fixed income today. And that's going to be used to govern what the impact of the 1,000 Monte Carlo trials look like on that investment. Beyond that, I can actually, import model portfolios from Riskalyze if I'm using that integration, or customize my own portfolios that maybe, align with a specific rate of return. And we'll talk about that in just a minute. But it's important to note that because those model portfolios or those asset classes that we build into this investment account is how RightCapital is going to project this data into the future. On the contrary, we can change that entry method from, instead of entering a total balance, to actually entering individual holdings or asset classes. And this is what you might actually see when you're importing data from, the aggregation tool, or maybe you're bringing in your, let's say, linked accounts from Orion or Black Diamond or Fidelity, all those great integrations we have. You'd actually be able to see individual holdings import and you'd see the actual quantity of shares, the price per share, and all this data is going to help us to not only determine the value of this taxable account, for example, but this data is also going to tell us, how we're going to project this information into the future, because the asset allocation will be based on the actual holdings or the asset classes that are listed under the account. And just the last note I'm going to make here, everyone, is that these accounts, if they are imported or linked from an integration partner or through aggregation with the link account tool, I just want to remind you that even if they come in with all different positions, let's say there's 30 ticker symbols listed, you can still change the actual investment strategy of this account by changing based on holdings to based on model portfolio. So even if I have all of these investments populating and determining the value of the account today, I can project it into the future with a different portfolio. So maybe that's a growth portfolio, or maybe it's my first trust moderate growth, or other options that we've built in here. But again, today we're going to keep it pretty simple and just align the actual asset allocation with the holdings and asset classes that were entered here. But those are the way we essentially determine where are the investments assigned today in terms of their asset allocation, and that is the starting place of how they will be interacting with the Monte Carlo projections and different return sequences. Now, one of the great places to analyze all this information that takes place in the data entry under the net worth is, of course, the investment tab. So the investment tab is where we can actually see the breakdown of our investment accounts. So we can see the current allocation tying to the data entry, where we can see a breakdown of all of our accounts, maybe the retirement accounts or general investing accounts, and you'd see the names of the accounts listed. But here you can see the actual averages for all the investments. Maybe we're at a 65-35. So between a moderate and a growth portfolio there, earning an 8.4% rate of return. But we can also see, the 60-40, the 70-30 portfolio and the different rates of return. And again, this investment sub-tab asset allocation screen is where we actually analyze those investments that we have within the plan from the data entry. And this represents the starting place. This represents what's happening today. Now, we all know that clients over their life expectancy tend to shift their investment strategies, right? When they're younger accumulators, they might be more aggressive. When they're retirees, they might be looking to get a little more conservative, let's say build up fixed income and cash over time. And the default setting in RightCapital in many cases will actually just keep this investment strategy the same. So today we can actually see that when we've just created a financial plan for the first time, we're actually, we might be seeing that this 65-35 breakdown of equity fixed income is going to stay consistent within the financial plan throughout the client's entire lifetime. And we can actually see that specifically within this allocation path, where we have the client's life expectancy on the x-axis, and we have the makeup of equity, fixed income, and cash over time listed. Now, it's very simple to transition a client's investments over time, and we have a couple ways to do that. So the first area I'm just going to quickly remind everyone of is RightCapital will allow you to actually adjust the pre and post retirement asset allocation for the investments within every financial plan. And that's going to be turned on as a feature by accessing the gear icon sub-tab settings. And in these settings, every single client is going to have a setting in the methodology area called allocation method. And here we can see that, we're using simply the same asset allocation that was entered as the day one information in the net worth to govern the investments throughout this client's life expectancy. But there are other options. So as I choose this drop-down menu, I can also look at what does pre and post-retirement asset allocations look like. So maybe for my pre-retirement, I'm focusing on the client's investments that were entered in the net worth area. But maybe for post-retirement, I'm expecting this client to get much more conservative. So I'd be able to illustrate that, or maybe move to a balanced portfolio. And that is actually going to allow me to change what the investment strategy looks like before and after retirement. And as I access the investment tab and look at that same asset allocation path that we saw previously, we can actually now see the nice visual shift during retirement to move away from that, 65-35 into a more 50-50 breakdown of equity, fixed income, and cash. So we can, again, change that as needed. We could show, what preservation looks like versus balanced, and we can access any portfolio that's been built or been integrated with the Riskalyze integration and showcase the change in investment strategy at different points within the financial plan. And this, of course, once we've changed that setting to showcase, let's say, that balanced asset allocation in the settings themselves, will impact the outcomes that we see within the retirement tab as we're analyzing what's the probability of success in my client living to the end of their life without running out of money. So we'd be able to see that impacting the current plan as well as the proposed plan. So, and we watched if we'd actually see a change in the probability of success in ending investable assets if I were to maybe adjust that back to just, the same asset allocation for all years. So as I save that in place again and head back, we might see, again, different outcomes within the 1,000 Monte Carlo trials that RightCapital runs on the data sets. So we can see, an 80% probability of success versus, what we saw before. Now, the third option I just want to make sure everyone's aware of here, beyond just keeping the asset allocation the same for all years and choosing a pre and post-retirement asset allocation to basically project the client's data with, is the actual glide path tool. So I just want to remind everyone that there is the option to essentially transition the client's assets slowly over time, much like a target date fund would do. And in this case, I can actually enable a glide path and tell RightCapital not only, is this a glide path that I'm just using as a default, which retires the client with a 50-40-10 breakdown of equity, fixed income, and cash, or maybe I've built out custom glide paths that retire at different, portfolio allocations. But I can say, for example, how long is it going to take me to move into the new investment strategy? Is it going to take 10 years to move from my current assets to the glide path, or is it going to take longer? So in this case, once I build this new glide path, we're then going to be able to see in the allocation path what the actual investment strategy looks like for this client. So maybe we actually want them to get a little more aggressive and then back off to a more conservative allocation over time. And again, all of these will have impacts on how the software interacts with this particular client's data as we run 1,000 Monte Carlo trials with varying market returns. So again, this is all going to, have a pretty significant impact on not only the, clients' ending investable assets, but also how they are going to be interacting with market volatility that occurs within the financial plans. And again, enabling that glide path would show the investment strategy shift for both the current plan and any proposed plans that we have. So one thing I just want to remind everyone of is that those settings, the gear icon settings area, are a really important area to understand, before you get too deep into presenting many plans, because of course the outcomes can change significantly based on what kind of asset allocation method you're using. Additionally, there's other settings that are important as well. So for example, I currently am automatically treating bank accounts as cash. But there may be instances where you actually want to manage cash as a goal. And this setting is important because if we use a cash reserve goal to manage cash levels, we're going to say that essentially I'm going to create a goal for this client to have 100,000 in cash at all times as our emergency fund. And so within the data entry under the profile goals, I would have to build that in as an actual cash reserve goal that we'd be able to see here under add goal, cash reserve. But if I forgot to do that and I actually had it set to use a cash reserve goal to manage cash levels, this 200,000 in the bank account here would actually just get automatically invested into the taxable investment accounts and earn a higher rate of return than cash. So you just want to be mindful, depending on your settings, if you're not automatically treating bank accounts as cash, and if you're opting towards using what's called a cash reserve goal, you will need to make sure to input that amount of cash that we will track within the plan. Otherwise, if I forget to input 200,000 of cash here, that amount is just going to be automatically invested again into the taxable investment accounts, and then earning a higher rate of return than we would otherwise see. So that's another important setting that relates to the client's investments. Again, gear icon settings, cash management method. So that's another good one just to be aware of. But today I'm just going to treat bank accounts as cash to not worry about that. And the last area I want to make sure we touch upon today is an important setting called rebalance across account types for the current asset allocation. And what this means is that we are going to average the investment accounts to create essentially one portfolio that gets projected over the client's life expectancy. And of course, that one portfolio is going to shift based on the allocation method, whether it's a pre and post retirement asset allocation or a glide path that slowly transitions to a more conservative approach. But if I uncheck this box, we actually see all the account types growing individually. They're not averaged together. But in doing this, we actually, when we uncheck this box, we remove the ability to shift the asset allocation over time. So as just a reminder, when we're talking 30, 40, 50 years into the future, when this rebalance across account types is checked, we're averaging the investments and projecting them into the future cash flows and with the returns and volatility that are going to be applied. But if it's unchecked, we actually would treat each account type individually based on their own rate of return, and we would then be able to we'd be able to see that they stay in the same asset allocation essentially for their whole life. That's kind of the trade-off you have to get with unchecking or checking rebalance across account types. So the last note here on looking at the client's current rate of return within the software, besides analyzing the investment tab, is the fact that you can monitor rates of return and I should say monitor cash returns in the actual future cash flows. So in the retirement sub-tab cash flows, everyone's going to have access to this invested assets tab. And here you'll actually see the beginning and ending balance of the entire portfolio and the returns that are associated with everyone's investments within the plan. And of course, as the glide path or pre and post retirement asset allocations are adjusted, we would actually be able to see a shift in the return percentages over time as well. So just note that that is available as an area just to reference the actual amount of return we see in the portfolio each and every year. Now, let's now take this to the next step, right? We know that in this particular instance, we are using, let's say, a specific strategy that's, transitioning the client's investments with a glide path. That's, slowly maneuvering the client's assets to a more conservative strategy over time. And there may be a position though where maybe we have, we want to turn that glide path off as a what if scenario, or maybe, start with a much more aggressive or conservative asset allocation to start. So these are all different strategies within the retirement analysis tool that you can use to provide hypothetical what if scenarios. So maybe in this case, I'm going to add in a separate plan. And to do that, I'm going to click add or remove plans that just says no glide path. So essentially the current plan has a glide path that transitions the investments over time, while this proposal has no glide applied. So no transition in investments, we can call it. And I'm doing this to kind of illustrate a point here, everyone. So as I build this in, I'm then going to be able to look at this plan separately here and say there's going to be no transition of investments. But what I can then do is turn that glide path off to look at a plan with and without those in place. And although what we might see is maybe a slightly higher overall probability of success in ending assets, there might be a point to make here that the glide path is going to maybe protect this client's investments if there is maybe a recession coming up, or if there's a time when we want to actually show them the what if scenario of what if things don't look so good in the future. So that's where we can actually look at these two plans and use the retirement analysis comparisons tab to actually analyze different sequence of return scenarios. So just so you know, the comparisons tab is technically not aligning with the Monte Carlo analysis. This is aligning to start with just one baseline growth assumption that is not introducing volatility. And in this case, if I actually turn on, let's say, a bad decade followed by slow growth, or a recession in 5 years as a singular trial that has some negative outcomes, we might see a different scenario. We might see a different play of assets at retirement, or we might see a scenario where the investments run out at different times. We can see all these different scenarios have different outcomes. So one plan might run out of money at 81 or 80, while the glide path does not, or vice versa. So these sequence of return scenarios can help us to analyze what are the differences between these two investment strategies within different outcomes. Another area where this can really be helpful is looking at maybe what is the benefit of some, let's say, more guaranteed income streams within the financial plan, with whether that's delaying Social Security or an annuity, or some cash value life insurance that's paying out. So you can simulate a bad decade followed by slow growth, or others. And we'll get into this in just a minute. But the other areas where you can drop in these different sequence of return scenarios will actually be areas like the retirement details income graph. So this is where we can actually see, with no transition in investments, if there is a bad decade followed by slow growth, we can see where the client or co-client is going to run out of money within this financial plan, and where the income shortages are. And maybe if we transition this to have a glide path or a different investment strategy, we might actually see a different outcome overall for this client. Different times where money runs out, different amounts of income shortages. And this is also, again, a great place to say, what are the benefits of more stability in the income? What if I optimize Social Security by delaying it until age 70? What's going to happen to our percentage of income that's stable in that case? And we'd see that jump from 28% or 24% to 28% as an example. So there's lots of different ways that we can leverage these different sequence of return scenarios for what we can think of as kind of individual Monte Carlo trials that we can apply to the outcomes within the financial plan. And this retirement analysis area is one of the best places to do that. The last area where we can actually see the impact of those different sequence of return scenarios is the actual cash flow reports. And in this case, we will actually be able to toggle on different sequence of return scenarios here in the cash flows by just very easily visiting those same settings under the gear icon, settings tab, and scrolling down to the bottom where we can actually allow the display of scenario specific cash flows by checking that box on. We will then have the ability to visualize, what the impact of a bad decade followed by slow growth would be on those future cash flow reports. So here again, we can see, for example, now there's this baseline drop down, and I can actually say in my proposed plan, what if there's a bad decade followed by slow growth? And I can analyze the portfolio returns as it relates to those different areas. So here we see negative returns occurring within the financial plan, and then some, slow growth, right? So some kind of mild returns moving forward versus maybe a recession that takes place 5 years down the road, and what impact does that have to the client's portfolio over time? So we can see, 5 years down the road, we have some major hits, and then we return to a more normal, growth pattern. And so what I want to just remind everyone of is these return scenarios are fully customizable, and every advisor license has the ability to both add them into a financial plan to show a what if scenario, as well as you have the ability to kind of customize what they look like. And all of that customization is going to be done within the advisor portal landing area under the models sub-tab. So the models of the advisor portal are important because this is, again, a global area, again, that applies to all your financial plans, that you can set up, let's say, either modeled portfolios that can be applied to financial plans, maybe, a 6% return portfolio, or an area where we can actually program in these customized return scenarios, where we can actually say, what do equity returns, fixed income returns, and cash returns look like over a set of years. And know that RightCapital, when we're looking at this, we'll just kind of align with the investments the client already has. So if the client is, has a majority of mid-cap investments or large growth investments, we're gonna be basically, staying consistent with those types of equity when we're talking about kind of the broad category. But we will be able to, again, customize what this is gonna look like in the future with, let's say, a recession down the road, or with one of our pre-programmed options of a bad decade followed by slow growth, a Fed adverse scenario followed by modest growth, a strong growth scenario, a flat 0% return scenario, or even others you want to build in. So I just want to mention that the Fed adverse scenario followed by modest growth is one of the only ones that we kind of pull from the industry. We kind of made the rest of these up as just options for you, but this is representing a typical solvency test for insurance companies on equity reserves. So this would be something that you could pop in to show what that would look like if clients could get through that. But again, you have the flexibility to add any new scenarios you'd like by clicking add scenario. And what we'd actually see is these new scenarios that we add in are fully customizable, but they actually will start off with the same data as the bad decade followed by slow growth. So when you add it in, you can see maybe a new scenario. You can then, work off that, maybe adjust part of it or just, some of it. But this is essentially the starting place. You can then customize this any way you'd like. Make sure it's aligning with what you want to see moving forward just by tabbing through. And once you do this one time, we can see this test scenario is then going to be available within every financial plan to actually apply and troubleshoot different outcomes with. So I know this is a lot of information today, everyone, and it kind of moves from step to step, from understanding just the basic assumptions that guide the investments that are input, to then talking through how those investments change over time, and then lastly, how those investments that may or may not change interact with the Monte Carlo analysis, and of course the different scenarios that we can build in and structure. So there is a lot of flexibility, of course, within Right Capital to really hone in on some of these nuanced details. But how you structure the financial plan is really going to be dependent upon the clients themselves. If you're working with a majority of clients who are already retired, let's say, there's a good chance that maybe they're going to be in the same asset allocation for the remainder of their financial plan, and maybe you don't need the glide path in place, or maybe you're looking at a client just who's in the 10 years before retirement. Maybe you don't need such a gradual shift like the glide path has. Maybe you can just go with pre and post retirement asset allocations to govern that. But this is all here to help you essentially align this information with the plan in a way that creates the most realistic outcomes and allows you to then simulate those different what if scenarios. So one thing I do want to also just add is that all of those settings that we saw within the financial plan can be aligned as your, let's say, favorite settings for all new clients that you enter within Right Capital. And that's going to take place under the advisor portal, under the gear icon, sub-tab account, sub-tab client presets. So again, this is an area where if you want to, let's say, have a default asset allocation method, you can, or you can, for example, choose to rebalance across account types and average all the investments, as just your default. Or you can, adjust how we treat cash, right? Is it automatically treat bank accounts as cash, or do we want to create a cash reserve goal? So again, global settings here will apply to all new financial plans that you create. So thank you all. You've been extremely patient. There's a lot of great questions here, and we're going to dive into them now. So we encourage you to stick around if you have time. If not, feel free to catch a replay, and we will certainly dive into any questions that you have. But I appreciate, of course, all the attendance and all the great comments that are coming through. So with that being said, Kelly, let's dive into these questions.
Hey, Dan, I hope you're buckled up because we have a lot of good questions today.
Wonderful.
So we can start with Steve, who asks, are returns net of inflation?
Yeah, that's a great question, Steve, that comes up a lot. And yeah, the returns will be essentially, built in net of inflation. Everything is going to be, of course, inflating over the course of the software, from the returns to, or I should say, the expenses, all the goals. So everything is going to kind of grow accordingly through the plan, but the asset returns here are broken out just specifically interest, dividend, capital gain that make up the total return on the right.
All right, next question we have, and I think it bears repeating, but does Right Capital update the returns automatically?
Yeah, thank you so much. That particular comment is great. We do, of course, update our return assumptions every year with, of course, the latest information. Keep an eye out for this year. Obviously, 2020, 2021 have been interesting. So, we, of course, run with 50 years of historical indexes averaged out for our equity data. 20 years of index data is average for bonds. So we should be putting the new assumptions out in the next few weeks. And again, keep your eye out for that email if you want to change them as well.
Awesome. We have a question from Craig, and I think this is a really good one. Can you adjust inflation for a period of time?
That's a great point. And you can in fact adjust the actual growth of particular costs over time. So an example of that might be, maybe you're looking to, build in some retirement expenses in the plan, or pre-retirement expenses, and you want to customize maybe, what that looks like. So, we actually have the option to create, expenses and customize, any inflation factor we'd like with different start and stop dates. So we can layer in different levels of inflation at different times. But I want to remind all of you that the actual system does have the option within the retirement expense goal to actually use different retirement spending strategies. For example, our guardrails strategy that will automatically adjust inflation based on market performance. So that's something to keep in mind. We can actually build in a retirement expense with a guardrail strategy that says, if, let's say, there's a negative return year or a 0% return year, that we actually won't apply general inflation for that year or the following year. So those are adjustments that you can make in the system. And of course, you can customize, individual expenses to inflate at different amounts. But, in terms of the general inflation settings here that we see under other assumptions, these are just going to be more global for the entire timeline of the financial plan.
Awesome. So George wrote in, if you change the volatility assumptions annually, but we don't have access to volatility, how do we keep it current?
So that's a great question. So, in essence, we will actually, I don't think we do too much adjustments on the volatility. Ultimately, we will provide, I think, just the return adjustments every year. If you are looking to have more flexibility to dive into volatility assumptions or add in customized asset classes, like maybe you want to build in a cryptocurrency asset class and adjust volatility and return specifically for that, you can just talk to your rep about customized asset classes and what it might look like to build that into the plan as needed. So there's lots of flexibility there, but you would need the actual platinum subscription to RightCapital to actually start maneuvering and adjusting these percentages.
Okay, Sherry asks, how do you get to using 2% dividend for all equity classes? Seems rather high for growth funds.
Yeah, again, we're pulling from, our historical averages, but I will say that one of the first things we really want all of you to do when logging into RightCapital is do exactly what Sherry's doing, is look at these assumptions and know if they're going to be right for you. Ultimately, RightCapital does need to break out interest, dividend, and capital gain specifically because of our really robust tax calculations, right? We need to know what level of qualified dividends are flowing from the actual investments, so we can appropriately categorize that in the tax forms and showcase that in the system. So really, we do have these kind of broken out specifically, and I think in that case, we were working off of the averages, but we wanted to make sure that qualified dividends were properly accounted for, and maybe we were overshooting versus undershooting in that kind of situation. But again, you are all able to adjust interest, dividend, and capital gains, and we think it's important to, again, make sure these are aligned with what you believe to be true moving forward.
Awesome. So Joelle asked about, what does checking the managed account box do? I'm assuming she's referring to under the profile net worth tab.
Sure. So I will say that, ultimately, your managed account area is actually going to translate to the RightIntel dashboard if you are a premium or a platinum subscriber. So you can see all of your managed assets here and the total percentage of assets under management. It won't have any impact, though, on the actual financial plan itself. So it's not going to, adjust the plan or how the accounts are distributed. It's all just going to work into kind of organizing that data for you on a high level.
All right. So Anthony asked, can you project the growth on the account level in a plan? For example, when doing a Roth conversion, Roth accounts likely grow at a higher rate than the overall portfolio, which benefits a Roth conversion.
Yeah, that's a really great question, Anthony. And that's where that rebalance across account types checkbox is going to come into play. So, if you are looking to have every account types like Roth grow differently than the 401ks and not just be averaged into, a formula for one portfolio that we're projecting into the future, that's where you can, in fact, uncheck rebalance across account types for the current allocation, and that would likely solve that problem for you.
Okay,
And
so
just real
sorry.
quickly, everyone, I just want to always remind everyone, if there are specific questions on a specific plan, we are always here for you Monday through Friday, 9 to 6 p.m. Eastern. So the support team is always going to be there to kind of get you the nuanced follow-ups to these questions. If you need to dive into a specific case study and work through it, just know we're here to help.
Perfect. So Will Cummins asks, is the link feature on the net worth screen a new feature?
Yeah, that's a great question. So depending on your broker-dealer relationship and depending on your subscription to RightCapital, you may or may not see that link account feature. So, it is available normally for all premium and platinum subscribers. The link account feature would allow you usually to link aggregated accounts into RightCapital, or if you've set up an integration and maybe you're a basic subscriber, let's say you connect to your Fidelity accounts that you manage, you might also be able to use the link account feature to actually import any managed position level account data through the integration partners we have. So again, kind of depends on your relationship, William. I would say if you have any questions, though, you can always reach out to support for specific instructions.
Great. We have a question from Edward who asks how the annual returns are calculated in the investment module.
Great question. So again, it all boils down to those asset return assumptions. So for example, in my general investing, account, which is my taxable account, we see a rough breakdown of 73% equities, 27% bonds. We can see the more nuanced details of that here with, what breakdowns we have. But this rate of return is essentially all based on the assumptions that we just talked about. So if we had, let's say, forward-looking assumptions from the JP Morgan report input, this 9% rate of return would probably be a little lower for a 70-30 portfolio. But again, all of that is customizable both globally and individually, but it does come down to the net worth and how the actual investment account is either, assigned value through either holdings or asset classes, or, also model portfolios that we can use to tie into the account. So again, hopefully that provides a little clarity for you. If you ever need a little more walkthrough, let us know. But again, you can see all accounts here, which is, again, your kind of averaged portfolio of everything. And then you can look at individual accounts. Again, even though it's an S on here, this is just one account. This is the taxable account. And any account you enter would be on the drop-down menu.
Perfect. So Mike asks that he has a client with 100% stock exposure in their Roth IRA. How would we account for that within the software?
Yeah, great question. So Mike, I mean, in that case, you just, in the net worth area, you just build in your Roth account here, add account investment, drop in a Roth, let's just call it a, in this case, Roth IRA, I'm assuming. So that would just make it easy. And what we'll do here is then just enter, either individual holdings, asset classes, or a model portfolio. In this case, I can just add in, asset classes with, the equity exposure. And this would then, again, just provide me broad asset classes, or I could just enter individual ticker symbols here. Again, not to use GE too much, but this will pull in through Morningstar. We could list the quantity of shares. Both of these would be examples of equity exposure within this $200,000 account. And as I visit my investment tab, we'd be able to see that new Roth account that I just entered has 100% equity exposure. And as long as we have the rebalance across account types unchecked, that would exclusively grow at that rate of return. Again, so I know it's a couple steps there, but we can always help you through it if you want to call into the support team or chat them if needed.
Awesome. We have a question from Lauren that says, for the allocation methods option, if we entered our own portfolio allocation, would those options be listed as well?
So, yes. So any portfolios that you enter into the system can be used in different allocation methods. So whether it's pre and post retirement, you can always, adjust them as needed. So, for example, I could, adjust my post retirement asset allocation to, a specific portfolio if needed. Here we can see, again, maybe an imported risk-wise portfolio or one that I've just built in custom here.
Perfect. We got a question from Edward that says, can you change return assumptions within the second phase return assumptions? I believe he's referring to the pre and post retirement allocation.
Yep, that should be, covered already, so we can move past that one, but that would just be listed right here under your settings, under pre and post retirement.
Okay, we got another question from Steven. Is there a way to change asset allocation over time based on a date? I'm thinking target date.
Yeah, that's something you can technically do. Now, things like the glide path are all going to correlate to the day of retirement. So the investments actually would adjust within the glide path to when the retirement is. So if you set retirement to 65 or 67 or 62, that's actually going to adjust the investment strategy. Same with pre and post retirement. So, hopefully that helps a little bit. Again, if you really want to get into the nuanced details there, we're happy to walk through it with you on a phone call.
Awesome. Do we have time for a couple more, Dan?
Yeah, we can keep rolling. And again, for anyone who has to drop off, just know that we have this on replay in the actual help center of RightCapital under the help icon. I just want to quickly showcase this, so if people do have to drop off, that we can make sure they catch a replay if needed. So here under the webinars category of the help center, you can actually watch every webinar we've ever done under watch previous recordings. So they're all here. We're happy to have you watch them on demand as needed.
Excellent. So we got another question from Sridhar here that says, switching between total balance and model portfolio and entering holdings loses previous info. Any solution for this?
I would say it does depend on whether the account is linked or not. So, it's something that if there is a linked account, it should update. If you're working with manual accounts, or as I say, update, it should have the data appear. But it's certainly something we can look into, and I'm happy to kind of talk through it with the development team. But that is certainly something we can take a look at for you, though.
Cool. So Edward asks, how is the probability of success calculated, and is this the Monte Carlo?
Yes. So the probability of success within RightCapital is really, the percentage of all 1,000 Monte Carlo trials that are successful in reaching the end of the client's life without running out of money. So in this case, 780 of the 1,000 trials were successful in the current plan of reaching age 90 without essentially running out of money. Now, this is just talking about investments, right? We can choose to sell a home, we can choose to sell a business, but the system is not going to do that automatically to fund cash flow needs unless you specifically toggle that on. And what we'd actually see in the bar graphs to the right is the median Monte Carlo trials ending investable assets. So trial 500 of the 1,000. So hopefully that helps. If you need more information on that, you can always go to the help center. There's some good write-ups.
Awesome. So we have a question from Jason that says, when does the glide path start? Is it tied to client retirement?
Yeah, so great question. The glide path is actually going to start based on the grading schedule. So it starts essentially immediately, but the glide path doesn't necessarily, fully take it, isn't fully in use until the end of the grading period. So if I set a 10-year grading, it's going to essentially take me 10 years to become fully invested within the glide path and for the system to ignore my current asset allocation. And what that means is, if I put a 10-year grading, that's going to transition the investments, faster to whatever is listed in the glide path. Versus a 40-year grading, which is going to do that on a much slower scale. The logic is, you can kind of make a quick adjustment with a glide path with a short grading, or you can, do a longer transition over time with a longer grading schedule. But again, that can be a tricky conversation to understand. So again, great resources in the help center if you want to hear and see more about that with nice visuals.
Perfect. We got a question from Jennifer. Is there a way to change the allocation path for all clients?
Yes, so that was the client presets. So just note that, in the gear icon account tab, under the client presets area, you can change the asset allocation for all new clients. So again, advisor portal, gear icon, account, client presets. Again, hopefully, we can see here that that's something you can adjust, but for existing clients, you'd actually have to go and manually and adjust them.
Cool. We have a question from Michelle. If we treat bank accounts as cash in the settings, then it grows at the rate the investment accounts grow?
No, sorry. So what we'll just clarify on is if we treat bank accounts as cash, the system will automatically take any bank account and align them with the cash rate of return listed in the system. So in this case, 1.59% in my financial plan. Again, that's for the asset return assumptions under cash. If you're using a cash reserve goal, you want to be mindful to make sure to enter it because if not, if you forget to enter a cash reserve goal and you're not automatically treating bank accounts as cash, the cash will become invested in with the taxable investment accounts. So again, some good write-ups if you want to actually just read the verbiage on the Help Center articles. They can certainly help as well.
Cool. So we have a question from Sherry. Can you repeat how you can have one plan with a glide path and turn it off for another plan?
Of course. So we want to remember that retirement analysis area, everyone, is really customizable. So in this case, the retirement analysis is actually going to allow you to pretty much toggle on or off, anything that's in the current plan. So in this case, the retirement tab that might include a glide path in the current plan would have an option in the action items at the bottom of the screen to actually turn off that glide path. So maybe I want to just, invest in a moderate asset allocation and not transition it over time with a glide path. And in that way, I'd be able to, again, directly compare and contrast these two outcomes and see, what they look like as it relates to the plan. So hopefully this is helpful just to see that back and forth in the retirement analysis tool. But the action items, again, are always the data points that we can adjust for the variable plan on the left.
Awesome. So Michelle is asking, my model scenarios don't have the 5-year recession. How do I get the inputs for this?
That's a great question. I had built that one out just customized to show the benefits of, let's say, an annuity purchase. I think that was where I built that out on one of our webinars. But just know that, in the models tab under the scenarios area, you're welcome to, just work off of the data that we have here. But in the 5-year recession, I essentially used some of the data from bad decade followed by slow growth and just kind of bumped it out a few years. So we had kind of a normal sequence of returns here and then just built in a few bad years. Again, the recession here is based on some just historical data, but historical references are always a great place to start, whether you want to look back at 2007, 2008, 1987, that's a good place to say, what did it look like for equity, fixed income, cash during that 5-year window or 2-year window, and that way you can kind of build it in and then use some of the other inputs as kind of your baselines to say, returning to somewhat of a normal growth assumption after a series of bad years. But again, hopefully that's helpful.
All right, Stacy is looking for some clarification here. If you select an allocation method, then you need to uncheck the rebalance across account types.
Yeah, so this is a little bit something we want to just clarify on here. The rebalance across account types option is going to allow us to transition the investments. So if rebalance across account types is unchecked, we're basically going to automatically use the same asset allocation for all years. And that is something that it's just kind of the way the system is built. But just be mindful, this is checked on as a default. It has to be checked if you want to change the asset allocation. If you'd like to, just treat each account individually, each account type individually, you can in fact uncheck this, but no, if we use pre and post retirement or glide path, it's just gonna not have as much impact essentially. So, unchecking this automatically uses same asset allocation for all years. If this is checked, rebalance, then you can use whichever one you'd like.
All right, Dan, we got a bit of a curveball from Keith who asks, what is the best way to model a buffered asset like a defined outcome equity ETF?
That's a really good question, Keith. So, I would say, that we do have some options for buffered assets. For that particular one, we'll probably just follow up with you today because it's getting a little bit out of the scope of the conversation, I think. But we will, certainly follow up on some best practices there for you, Keith.
Cool. So Robert asks, it's helpful to name the plans like we did with the no transition of investments plan. Can we get rid of the proposed plan or at least rename it?
Yeah, Robert, that's a great question. I love it. I think that's something we definitely hear a lot about, and we do want to, look at this, in a way that's going to present the most accurate information to your clients, kind of detailing what the plans are. But I will say that in this case, we can't yet remove the proposed plan or rename it. I'll certainly pass it along to the development team, though. I think that's a valid point.
Cool. So we have a question from Mark. Does allocation over time take into account taxability of registration type, taxes on IRA reallocation versus individual?
Yeah, great question, Mark. Thanks for asking. So essentially, what we're talking about here is, allocation over time. We will look at all the different nuances of those investments and the breakdowns of not only interest, dividend, and cap gains, but also, portfolio turnover. That's going to impact things like taxable accounts. So, we want to remember we're not looking at the individual positions, but we are looking at broad asset classes. We are looking at account types, and we're talking about changes that will impact taxes overall. So for that kind of specific question, there will be certainly some adjustments to the taxation based on the allocation type. The taxes on, let's say IRA reallocations versus individual will be, showing some adjustments. But for specific examples there, I'd probably recommend you kind of talk to the support specialist, walk through the specific plan, and we can certainly do that with you, no problem.
Cool. We have a question from Brian who says, can capital gains be added as income and taxed at the appropriate rate?
Sure, absolutely. So in the profile income area, Brian, you can always just build in some other income here, add income, other income, and that does allow you to customize taxation. So let's say we have 20,000 of long-term cap gain, we can add it in and have it simulated exactly as it should for tax purposes.
Awesome. We're looking for a little bit more clarification here. The returns on stocks and bonds that are default, are they net of inflation?
Yeah, so they are in fact net. So we are looking at, essentially the breakdowns we saw. You can adjust them as needed, but as a baseline, that's what we have essentially.
Awesome. So Michelle is looking for some more clarification around the guardrail setting. Why would we decrease inflation with the guardrail? Is that because we want clients cutting spending back?
Yeah, that's correct. If there's a negative return sequence, Michelle, generally, a real-time adaptation that the client might make would be to, reduce their spending with, to let their accounts build up a little bit. So in the retirement spending tool under the models tab, you can in fact adjust the guardrail strategy. So here we can see, for example, are we going to do an inflation adjustment or not? So you can choose to, toggle that on or off, but it is something that is going to be available if needed.
All right, so we have a question from Thomas. Where does it show on the assumptions to account for management fees?
Great question. So management fees will automatically reduce the actual invested asset returns within the financial plan, but we won't see that in the assumptions tab. You'll actually see an area to input AUM fees specifically under the profile tab, sub-tab expenses within the taxes and fees card of every plan. So here you're actually going to see an area to input AUM fees that will reduce all non-annuity invested asset returns. Again, profile expenses, or step 5 of the initial data entry under the taxes and fees card.
Cool. So we have a question from John who says, sorry, pretty new to this. How often are these types of trainings conducted?
Great question, John. Every single week on Friday at 1 p.m. Eastern time, we are here to help. Obviously, we have different topics we kind of cycle through. Once a month, we'll generally do a recap of the latest product updates. The other 3 weeks of the month, we focus on a specific topic. But again, you can catch all of the replays under the webinars area of the Help Center.
Okay. Okay, we have a question from Teresa. When modeling a Roth conversion in the tax distribution tab, why does it convert the entire IRA account? Is there a way to stop it at a certain point, like when RMDs are just below the allowable standard deduction?
Yeah, really great question, Teresa. So, the logic is that this tax distributions module is here just to kind of provide the initial visual backdrop of the conversation you're looking to have. And although we certainly are happy to pass along the feedback to kind of have stopping points for these, what you can always do is just use this as, let's say, a guide. So in this case, for those of you who are newer, we can see the taxable income over the client's life expectancy. We are filling up a lull in income with Roth conversions to essentially reduce taxes and taxable income later in life and create more tax-free assets, and obviously showing a pretty significant benefit in the process. But what we see is that this bucket that's being filled up is taking advantage of all the possible Roth conversions to fill up a tax bracket, whether it's ordinary income, cap gains, or Medicare premiums for IRMA penalties. But we can just use this details tab as a guide, right? So this is going to tell us that we have X amount of conversion amounts possible in each year that we list. So 268, 264, 276, but there's nothing saying that we can't just do 150,000 from 2046 to 2050, keeping us under the threshold we want to be at, but while not still converting the entire IRA account. So you can use this area as a guide, but happy to pass along the feedback. And again, you can create those manual Roth conversions for the portion of the outcome you want to see, and then you can actually look at the specific plan to see the impacts overall. So again, hopefully that helps. We're happy to help more if needed, though.
Cool, Dan. Do we have time for a few more?
Let's take a few more. Yeah, we're almost at the bottom of the list. So
Sure, I know. So Michael asked what I'm going to call the question of the day. Will adding annuities always decrease the Monte Carlo probability of success?
That's a really great question. And again, I think this is one where understanding our software really helps to be able to model that. So, when we're talking about, let's say, comparing two outcomes, right? If we're looking at an investment account that's earning a 7% rate of return, and we're looking at an annuity with some guaranteed payouts, and we're comparing them within like a baseline probability of success, having no volatility built in or having limited volatility built in based on the other investments, may or may not, show a whole lot of value to that annuity. But obviously, where the annuity is going to benefit the client is where there is going to be, protection on downside risk. So if the client does in fact have a very aggressive portfolio, and they get an annuity, there's a chance that that annuity will help, right? Or if we model comparisons and look at, again, a downside scenario, bad decade followed by slow growth or others, that's where, certainly the annuity can shine, and even really focus in on how much income is stable. And so we might really want to see that annuity income, increasing the income stability or removing an income shortage when there is a bad decade followed by slow growth, for example. But, ultimately, there's a couple other things that are important. Number one, making sure you have, a transition in assets over time. So maybe you're not comparing the clients being invested, in a 70-30, for their whole life versus, an annuity. Or, also making sure you're comparing accurately an annuity that might have some fees to investments that actually have AUM fees as well. So again, the taxes and fees card here, making sure you have an AUM fee if that's what you're comparing the annuity against. If you're showing investments without fees, annuities with fees, and trying to compare the two, again, and it might not be a purely apples to apples comparison. But it's important overall, sorry about that, everyone, to just make sure that, if you're having trouble, you can always reach out to the support team. They can help walk you through the information as needed. But I always like to hone in on the areas where we can really focus on, the benefits of the different strategies as it relates to, guaranteed income that's stable, eliminating income shortfalls within, negative return sequences and all that. So hopefully that clarified a little bit.
Cool. So we have a contender for question of the day now coming from Tim. Can we show taking from a cash value life insurance policy in down years and not taking from market assets in those years?
Yeah, absolutely. That's a great question. And so ultimately, we can always show, cash value distributions when they're needed. So an example would be, let's look at a year where we might need some, so we can look at withdrawal rates from invested assets here. Let's just say, for example, between age 67 and 70 before Social Security kicks in, this client wants to have some distributions from their life insurance policy or buy a life insurance policy and distribute from it. So number one, I can always distribute from an existing policy, but in this case, maybe I'm building in a actual whole life policy here for the client, and know that the actual client can actually build in all, or the advisor, I should say, can build in all the variables of this new policy and show cash value that can, of course, be distributed as needed. And so we can take tax-free loans or do a full surrender. We can take X amount of money, 20,000, let's say, between the client's age, 65 and age 67 or 70. So again, this is something we could build in. We could show obviously the inputs here, but then we'd be able to see, what the impact of this, policy with cash value that distributes would, provide within the income sources, within this plan. So here we can see the other income, flowing out of the plan. You can hone in on just guaranteed income streams here pretty easily, but we can see the percentage of income increase. We can see the withdrawal rates from invested assets decrease. So lots of flexibility there. Again, there's some specific webinars devoted to that if you need more data.
Awesome. We got a final question from Jason, and I think this is a major one today about our returns and are they in fact net of inflation?
Okay, so it says, so the returns have inflation subtracted from them, net of inflation. Perfect. So, okay, so in this case, what we're saying is that, inflation is a separate entity, from the returns, and so they basically are not net. So in this case, right, we have both of these, inputs kind of tailored individually. I would say that, in this case, we are in fact looking at our returns. They are not essentially having inflation built in necessarily. We show, the gains, the dividends, the interests. We have the other inflation assumptions available to adjust. And, when we think about how RightCapital works, we're really looking at, kind of full calendar years. We're looking at, end of each year. Is there a net positive? Is there a net negative? How is that impacting, the actual investments and being depleted? So I always, want to be able to say this is kind of a tricky question the way it's worded, I think, but ultimately, we do separate them out. If you need any more information on it, Jason, don't hesitate to reach out. We're happy to provide more data. But, in this case, everything is going to be, kind of set up in a way that hopefully accounts for all the variables that you want to be able to play with and kind of customize for each plan. So, happy to do some more research if needed, but, you can always reach out to support if you have any additional questions on it.
Perfect. So we've got a few folks to follow up with here, but I think that's all for questions today, Dan.
Okay, wonderful. Well, thank you so much, everyone. We genuinely appreciate your time as always. We knew this one would take a little longer than usual, but we appreciate those of you who stuck around. Anybody who's watching this on replay, thank you for taking the time to go through this and get a little deeper understanding of RightCapital. Hopefully, it helps to create a better plan for your clients and hopefully a better presentation for you. So we hope you all have a wonderful weekend. Stay safe, stay healthy, and we'll see you next Friday.